Welcome back to the Deep Dive. We process the earnings calls so you get the key strategic insights.
Liddy, it's Richardson Electronics, ticker RELL. We're digging into their Q1 fiscal 2026 earnings call. Pretty significant, this one.
Yeah, it's the first full quarter since they sold off their healthcare business, so it's a look at the new, leaner RELL.
Exactly. So our mission for you, the listener, is to cut through the numbers and really understand what drove that big market reaction.
And what management's telling us about where they're placing their bets for future growth. Because this print, it definitely felt like an inflection point.
Oh, absolutely. Let's start right there with the immediate reaction. The enthusiasm was, well, completely justified by the headline.
A huge beat, right. Shares jumped almost 12% right away.
They did. And, I mean, Look at the GAAP EPS. It came in at $0.13. The Zacks consensus was way down at what, 0 deals in the tooth?
Wow, 13 cents versus 2. That's a massive beat for one quarter, an 11-cent difference.
Huge. And the top line, revenue, also performed well. $54.6 million, nicely ahead of the $51.5 million estimate.
Okay, but here's where we need to add that bit of nuance, right? Because the headline, revenue growth was only 1.6% year over year.
Right. And if you just saw that number, you'd be asking, why all the excitement for 1.6% growth?
Exactly. But like we said, you have to adjust for that healthcare segment sale back in January 25.
Once you strip that out, the core ongoing business, it actually grew 6.8% year over year, much healthier.
That's the clean growth profile the market liked. That's what they were rewarding.
And that cleaner revenue dropped right down to the bottom line. Gross margin expanded to 31.0%.
Up 40 basis points year over year.
Yep. And even more striking, EBITDA nearly doubled. It jumped from $1.7 million last year's Q1 to $3.3 million this quarter.
Double. That really signals the leverage, doesn't it? Costs growing slower than revenue. It sort of validates that strategic shift they've been talking about.
Towards those higher margin engineered products, exactly. Which leads us nicely into the segment performance, and that's where you see the strategy playing out.
Okay, let's unpack PMT first, power and microwave technologies.
Yeah, PMT showed some really impressive core strength. Total segment revenue was up 2.8% year over year.
But again, you have to adjust for that divested healthcare piece within PMT.
Right. Once you do that, the core PMT sales were actually up a huge 10.5%.
And what's really interesting is where that came from. It wasn't just general growth.
No, it was super focused. The semiconductor wafer fab equipment business within PMT, that was up an incredible 52.2% year over year.
52%. That's a massive signal. It shows that the improving demand in semi-cap equipment coming off those recent lows is hitting RELL's results right now.
Definitely. Then you've got Canvies, their custom display unit.
How did they do?
Solid. Grew 8.3% year over year. They mentioned improving conditions, especially over in Europe.
And they have a decent foundation there too, right?
Long, a very strong foundation. $38.4 million backlog, so good visibility there.
Okay, then there's GES, Green Energy Solutions. This one always seems to need a bit more context.
Yeah, the headline number looked a bit negative. Revenue was down 10.2% year over year. But as management quickly pointed out, that dip was purely because they were comparing against Q1 last year, which had a really large non-recurring order for EV locomotives.
The tough comp issue.
Exactly. So you pull out that one-time sale, and here's the key number. The core wind turbine segment within GES grew a massive 86.1% year over year.
86%. Okay, that's the number that matters. That confirms the strategy. The pivot towards that high-growth aftermarket wind repower business is really gaining traction.
Absolutely. And it ties right back to the margins we were talking about earlier.
That 40 basis point expansion overall?
Precisely. They attributed it to a better product mix and improved manufacturing absorption, making more of their own engineered solutions in-house at their LaFox facility.
And you saw that in the segment margins, too.
Yeah. PMT hit a 31.3% gross margin, and GES reached 29.6%. These manufactured solutions are their highest margin products.
And all that focus meant operating income more than tripled. Hit $1.0 million. Operating expenses came down nicely as a percentage of sales, too.
Right. And there's a really crucial detail here, kind of buried in the financials that you need to understand. They reported $1.4 million in other income.
Okay.
About $0.9 million of that was a one-time gain from some confidential contractual settlement. But here's the thing. That's booked below the operating income line.
So the tripling of operating income to $1 million was clean from actual operations.
Exactly. It wasn't propped up by that one-time settlement.
Yeah.
That's a sign of, quality earnings,
Right.
real operational improvement.
So with all this operational success, how's the foundation looking, the balance sheet?
Incredibly strong, rock solid, actually. They ended the quarter with $35.7 million in cash.
And debt.
Zero. Nothing outstanding on their $20 million revolving credit line. And they extended that facility out to 2028, by the way.
Good financial discipline. And it's showing up in cash flow too, isn't it?
It is. This was their sixth straight quarter of positive operating cash flow, $1.4 million this quarter.
So the board felt comfortable declaring the dividend again.
Yep, the regular $0.066 quarterly dividend. And that backlog remains really robust, $134.7 million, giving them good visibility for future revenue.
Okay, so that's the rearview mirror. Let's shift to the forward look, the catalysts, because this is where that initial 12% stock jump seemed to run into maybe slightly more cautious words from management.
Yeah, that's the tension. Management's tone was constructively bullish, I think was the phrase. But they did outline a somewhat cautious cadence for the near term.
Okay, let's break that down. What about Green Energy Solutions, GES?
They expect double-digit growth for the full fiscal year 26, driven mainly by wind repower activity, aftermarket upgrades.
And they mentioned the policy angle too, right?
They did. Specifically called out the Big Beautiful Bill, referencing current government policy, and the tax benefits it provides for upgrading existing wind turbines. That's a direct tailwind for their repower business.
And they're looking beyond North America too.
Definitely. Right now, about 70% of GES sales are in North America. They're actively targeting Europe and Asia, introducing new platforms for non-GE turbines like Suzlon and Nordex, really broadening their market potential.
Okay. And the semi-fab business, the one that jumped over 50% this quarter, what's the outlook there?
Management's tempering expectations just a bit near term. They see that Q1 run rate continuing through the first half, so Q1 and Q2.
With the real acceleration coming later.
Yeah, they expect stronger growth kicking in Q3 and Q4. That's based on forecasts from major customers, like Lam.
Got it. Now, there's one big near-term thing everyone's watching, isn't there? The GE Ultra 3000's approval.
Absolutely critical. That's the big catalyst. The final sign-off is targeted for Q2 fiscal 26, just waiting on final signatures, safety testing, that kind of thing.
And why is that approval so important?
It's the commercial proof point.
Yeah.
Getting that sign-off should significantly broaden their channel access within GE's huge wind repower market. It sort of validates the whole strategy in a very public way.
And supporting all this growth requires investment. What's the capex plan?
Projected around $5 million for fiscal 26. And it's not just keeping the lights on. It's very strategic spending.
Oh, pistol.
Entirely focused on expanding their made-in-USA manufacturing capacity. Upgrades at the LaFox facility, building out the new design center down in Sweetwater, Texas.
When's that expected online?
Targeting Q2 fiscal 26 for operations there. And they're also pushing ahead with a battery energy storage system, the ESS demonstration site, with support from the Rev Illinois program, positioning for that rapidly growing ESS demand.
Okay, so if we tie all this together, the big picture story post-divestiture is much clearer now.
Yeah, it's a tighter focus on these higher margin engineered solutions in PMT, GES, and Canvys. They're really shifting from being just a distributor to being a specialized, vertically integrated manufacturer.
Which brings us back to that market reaction, that discrepancy. The stock jumps almost 12% right after the print.
Right, suggesting the market may be priced in an immediate acceleration starting Q2.
But management's guidance was more like, hold on, steady run rate through the first half, then acceleration in the second half, Q3, Q4.
Exactly. And that tension probably explains why the stock gave back about 5% the next day. Investors were digesting that sequential cadence, realizing the fundamental growth story might be more back half loaded.
But fundamentally, they seem well positioned, with semi-cap improving and the wind repower trend.
Yeah, the tailwinds are there. The core strength seems to be how they're aligning their legacy products with new tech partners, KBA, GAN, Wulong, to deliver these complex engineered solutions. That's what drives those 30% plus gross margins.
Okay. So let's wrap up. And as always, we come to our segment where we float an outrageous but maybe plausible trade idea. Just for discussion, of course. This is absolutely not financial advice.
Definitely not advice. But okay, given that super strong balance sheet, the $35.7 million cash, zero debt, and that very clear, defined near-term catalyst we just talked about.
The GE Ultra 3000's approval in green energy.
Right. You could maybe see a leverage play focused purely on the timing of that catalyst.
Okay, what's the idea?
Maybe something like a short-dated, moderately out-of-the-money call option. say, targeting expiration around the end of Q2 fiscal 26.
And the thesis.
The thesis is that the formal announcement of that GE Ultra 3000's approval hitting the wires, that specific event could be the risk-off moment the street needs to fully validate the GES strategy.
So the announcement itself could pop the stock.
Potentially. It could send the stock past, say, the $13 mark almost immediately, even before the actual financial acceleration shows up in the Q3 or Q4 results the management guided towards.
Interesting. So it's a bet purely on management hitting that Q2 timeline for the announcement. A binary bet, high conviction.
Pretty much. A high risk, obviously, like any short-dated option play, but plausible given the setup.
Okay, so recapping RELL's quarter. A really solid beat, good operational leverage, margin expansion showing up, and a clear growth path laid out around engineered solutions, semi-fab, and wind repowering.
Definitely. And I think the central strategic question now for anyone looking longer term, past this Q2 catalyst, it's about that cash pile.
The $35.7 million cash plus the $20 million credit line. How do they deploy it?
Exactly. Do they stick with the current $5 million capex plan, organically chasing that made in USA manufacturing demand? Or do they reserve that firepower for strategic M&A? They did mention acquisitions as part of the longer-term plan.
Right. So that tension between organic investment versus maybe a more aggressive M&A strategy, that's the key thing to watch over the next few quarters.
That's the big question, I think.
Okay, that wraps up our deep dive on Richardson Electronics. Thanks for joining us. And please always remember to consult your own financial advisor before making any investment decisions.